Welcome to episode 187 of The Numbers Game. I'm Jase. I'm back with Nick and Marty. How you going, fellas?
Oh, I feel great. Jase. You're back. I didn't know where you went. Found out you went to conference, but luckily our producer, Tommy Jackett, jumped in for 3 wonderful episodes. But, geez, it's great to hear your dulcet tones opening the show. I'm good, mate. Where did you go? I was
in Lawn for nearly a week, and just kind of timed for one of our recording sessions. And lucky we've got such a great producer, Tommy, to jump in. There was a poll that I saw went out on socials. Do we want Tommy in full time over Jase? And I was a bit worried about the results there, but I'm glad you guys got me back. Great to be here. And the episodes you did while I was gone were great. Just revisiting some of the amazing conversations that we've had. It seems, Aussies they are hot on the topic of things like tax cuts and where their taxes go. Don't get Nick started on payroll tax, but we're here just to kind of have these conversations and empower everyday Aussies to make better decisions. So bring it on.
How are you, Nick? How you going, mate?
I'm good. Yeah, refreshed. It's a Monday, the day we're recording this. So just coming off a pretty relaxing weekend. Ready and open to chat about payroll tax whenever you guys are. It's actually been a while, so maybe we revisit it. We can't let these things just go.
Before we go into tax, you've imported some lovely honey on Friday, and it was prestige honey, and Nick was talking it up all Friday to the boys in the office and the ladies.
Where are we going with this?
And this was probably the best honey you could ever have. And by the end of the day, all the honey had left the premise, and Nick had bought it as a gift.
I knew you'd bring this up.
Unbelievable.
I can't say too much, but I came across a guy who's has a business that he's going to launch, and it's I guess honey with health benefits, and he brought in 6 samples, I guess, for me to try and try on family, friends, and stuff around pain reduction and stuff. We might talk about it one day, but can't at the moment. So I was showing everyone this honey, and in a rush on Friday, I left a good chunk of it, actually all of it, in the kitchen, in bags, and I came in Monday and it's all gone. So, I think the fact that it was in the kitchen, and I shouldn't have left it. I was in a hurry and put it down and then didn't pick it back up, but everyone just thought it was theirs. So I've spent the morning trying to locate the honey, which I have all but 1 jar at the moment spoken for. So, fair to say it was some disappointed people in the office who thought they'd scored this really cool honey, which you actually can't buy because it's illegal to buy here. You can buy it in India and you can buy it in the States. You cannot buy it here. So it's been an interesting morning.
Just a lot of Winnie the Pooh type brokers around at the moment, looking very relaxed and very satisfied. Very satisfied. So if you got Nick's honey out there, our brokers listening, please just give it back. We want it back.
Yeah, and I think the key learning for me is that the kitchen table in here is a free-for-all. So anything you leave on the kitchen table is fair game. So, I'll learn, I'll be better next time, and I'll make sure that if I do forget it, I'll leave it somewhere else, not the kitchen table.
By the way, while we're on this, if anyone's got my charger, for goodness sake, give it back. I'm on 2%. So just if it's someone else's, don't take it, for goodness sake. Jase, what have you got for us? Bring us back to sanity and take us along the path you're going to take.
Well, given, at time of recording, we're around end of financial year 2024, in case somebody in the future is revisiting our archives. It's June 24, end of financial year has been madness. Like in accounting land, we describe it as what retail is for Christmas in December. That's end of financial year for accountants around May and June, especially in the tax industry. But I came across a few articles that I thought was worthwhile sharing before we roll over into the new financial year, basically based around the stage 3 tax cuts. Now, so many things also get announced in our country when it comes to tax law changes, legislation, amounts you can put into super, payroll tax rates, different thresholds. And one of the big ones that came out kind of towards the end of last year that has been talked about for a long time, was the stage 3 tax cuts. Now, there was talks about, the high income earners getting too much of a benefit and, what were these stage 3 tax cuts really going to achieve? Now, beyond all of the politician bullshit, I just wanted to bring this back into something that was really neat and simple and easy to understand for everybody listening. And what that is when you end up with extra money in your pocket, quite often, if you don't make a plan for it, it's very easy to spend. Especially when we're talking, the average saving for everybody next year. Now, this is spread out across everyone. You're going to have close to $2,000 more in your pocket next year, spread out over the year. Now, the actual average is $1,889, which I think that works out to be around $36 a week. Let me do the math on that. Can we make sure I'm not too? Yeah, $36 a week. Got it in my pre-notes. Now, that doesn't sound like a lot. So, Jase, you bring up stage 3 tax cuts and benefits for Australians. What kind of great impacts can we have with $36 a week? Now, the thing I was talking about was if you don't make a plan, you're just going to absorb that $36 a week, $100 a week, $50 a week, depending on how much cuts you're up for. You're just going to spend that. You're going to find a way to spend it. You're going to buy the extra T-shirt, the extra pair of shoes when Nick goes to store and not online to buy his things. You're going to spend some extra money on coffees, and you're going to get to the end of the 24-25 year, and you're going to have maybe the same amount of credit card debt. You might not have chipped away at the extra repayments on the home loan, and maybe you're still battling a help debt. So what I wanted to talk about today was what are the options and how much of a benefit does it have to utilize these stage 3 tax cuts to have a bigger impact than what, $36 a week kind of sounds like it's not going to have a big impact. What do you guys think? Have you guys heard much about stage 3 tax cuts? Have anyone kind of mentioned what they're planning on doing with the extra money they're going to have in their pocket?
I would just say no. Well, apart from the stage 3 tax cuts, I probably know less than you because you're an accountant, I'd hope. But I love what you're doing here because if I look at, not just in our business as financial planners, but we've spoken about this a lot on the show, particularly Marty, the power of compounding and how little bits or little things make a significant difference over the long term. At the end of the day, we've been living the way we've been living and we've been getting by. Well, most people have anyway. So anything extra in your pocket, obviously what the government is trying to do is stimulate the economy. So they want you to put that back into the economy, which I think most people will. But if you've got the discipline to continue living the way you have been, I look at the things that we do with financial planning. So you're either putting that money into debt, you're investing that money on a regular basis. You're putting that money away for your kids' education. You're putting that money into your super fund, whatever it might be. But if you've got the discipline to keep living the way you have been and use that money for something else, it can have a significant impact. So I really like where you're going to go with this, Jase.
No, for sure. Marty?
Yeah, and the immediate thing I did was, like Nick was talking about, $36 a week compounded at 8% over 10 years is, $27,197. So you got your regular deposits of $18,720 and interest of $8,441. So that's just over 10 years on 8%. So it shows you how those little amounts can really incrementally jump up over time. And while you're chatting, Jase, I'll look at the impact of what that is in a mortgage as well in a moment.
Yeah, for sure.
So carry on.
And they're definitely the things to consider. And again, my brain's wired this way too, that if I don't think about it in advance, I find a way to make cash disappear pretty quick. And also being in my position, Nick, as you talked about, I get to see this stuff all day, every day when it comes to people's tax brackets, people's taxable incomes. And I'll probably start straight off the bat by saying one of the biggest things that is impacting everyday Australians right now is their help debt. Now, historically, for the whole time I've had my career, over 10 years of doing tax returns and looking after small business owners, help debt repayments have never been an issue. It's always just been, the tax is withheld on somebody's wage or salary. It makes a nominal repayment against a help debt that's going up by maybe 1% of indexation a year up until recently. And, so people are in no rush to pay it back. I mean, if you've got a home loan that's at 4, 5, 6%, you're going to put more money on your home loan. If you can put money into super and earn more money on your super, you're going to do that. So you're in no rush to repay your help debt. Now, all of a sudden, the last 2 financial years, we have never had people more shocked and more worried about their help debt repayments than what we have now. What's generally happening is and for those playing at home, if you have a help debt, the repayments are calculated based on your taxable income. So as a hypothetical, if you earned $100,000 roughly, 4% of your taxable income is calculated for your help debt repayment. So you would pay back $4,000 against your help debt for a particular year. Now, let's say hypothetically you had a $100,000 help debt balance, which we're seeing more and more, these really big help debt balances for people that have studied, 1 or 2 degrees or a master's, post-master's afterwards. This person knocked off $4,000 off their help debt, which is just their standard repayment according to the government. Whereas last year when indexing was applied, it was applied at 7.1%. So the person's help debt went from $100,000 up to $107,000. And then 4% was knocked back off, so $4,000 repayment. So this person's now got a help debt of $103,000 and have not made any additional grounds towards knocking off their help debt. Now that's obviously an extreme scenario, but you see it across the board, because even if you bring it back to somebody who's earning $80,000 with a $50,000 or $60,000 help debt, the same numbers kind of apply, that you're making a much smaller percentage repayment of your help debt, and then indexing is being applied. Now, the budget back in May came out and said, oh, look, indexing at CPI, isn't going to be the way it's going to work moving forward. We'll take the lower of wage growth and CPI. So they're going to go back this year, and it's going to be around 4%. Now, again, if we apply the same scenario as that $100,000 earner who pays 4% off their help debt, but on the 1st of June every year, it gets indexed up by 4%, we're kind of going nowhere. So these everyday Australians are going to end up carrying this help debt ongoing for years and years and years to come, which obviously affects your borrowing capacity to buy a home, and it affects your retirement income one day too, because if you carry that help debt all the way through to retirement, which I haven't seen too many of those cases at the moment, but that's because help debt has come in and HECS debt has come in at an age where the people who copped those loans, which they thought were going to help their future, and maybe some it did and maybe some it hasn't, but they're going to cop this income all the way through their lives and continue to have to pay that back. So the big thing here I'm saying is, if you're looking at these stage 3 tax cuts and you potentially have an extra, average $36 a week, but you might be someone who's got $50 or $60 a week more. What I'm saying for you, if you have a help debt, is you should focus on getting that money into a separate high interest savings account. And before the 1st of June 2025, you're going to take that whack of money and you're going to put that against your help debt to help you get ahead. That's step 1.
Is there anything stopping, if someone gets a mortgage, obviously, you can pay out that help debt at any time if you've got enough equity? There's no sort of ramifications of doing that whenever a client wants to do that, Jase, from your understanding?
Yeah. No, you can pay off your help debt at any point in time, as long as you can grab the cash. And I guess, look, if you map the numbers with your advisory team, broking team, to go, well, look, if I've got only 10 or 20 grand left on my help debt and it's going to go up between 4, 5, 6% every year with indexation, am I better off knocking that out in advance and then paying it down a different way?
Because that methodology is financial suicide on help debt. If you're only paying us that small portion back each year and your debt is compounding, that's exactly the total 360 to what I was talking about what you can compound that interest with. And like I said, even if a client does get to a point where they have equity and they can pay that help debt out, and here's an example on the mortgage: $36 per week on your mortgage at $600,000 a year equates to an $80,000 saving over the term of the loan. So you can see, look at the reverse of what I said before when you're investing it to when you're deleveraging debt. That is really significant. So for help debt to be actually going backwards with your repayment, it's no different to saying, here's the minimum repayment on a credit card and your outstanding is going up all the time. That is ridiculous.
The other quick one I'll throw in there is the credit card. I mean, if you've got the credit card and you're not paying back the amount you need per month, or you're not knocking off the balance completely and you're copying 20% interest on a credit card, these extra repayments, if your credit card statement comes out and says the minimum you need to pay is $200 for the month, there is absolutely no way you should be making the minimum repayment heading into next year when you've got these stage 3 tax cuts putting some extra money in your pocket. And I know there's cost of living pressures and everything else, but at the moment, if you've been getting by the last couple of months making just the minimum repayment on your credit card, and you're now going to have an extra $30, $40, $50 a week in your pocket, that needs to go on the credit card. You got to divert it to the where it's going to have the most and biggest impact, and that outside of help debt, outside of paying off the mortgage if you've got one, it needs to be looking after your high interest debt, being a credit card as well.
100%. The highest interest debt needs to go. If you haven't got a home, definitely get rid of the credit cards ASAP. And work your way down. If you've got a mortgage and you've got equity, consolidate it and come up with an accelerated repayment based on the same amount of repayments that you would be spending now or up for now, and you will accelerate that debt to come down more than you'd ever imagine. So, yeah.
And I got a bit of an example around how superannuation as an additional tax deduction will work. Now, to make sure you don't touch this money if you can't trust yourself, if you know there's extra money per week, you can contact your employer and say, you know what, I'm going to actually do a salary sacrifice into super. And you could elect to have that extra $30 or $40 per week direct debited out of your pay or taken from your pay and automatically paid to super, which would increase your retirement funds. So I would argue, I'm not a financial advisor, so this is general from my point of view, but if you're towards the tail end of your career, 40s, 50s, heading into 60s, that would be just an easy one to set up to boost your retirement savings and get that extra cash in there.
Yeah, I'd not challenge that, but I would go a step further and say the younger people, because if we go to Marty's example where he was talking about a saving, and I assume you're talking over 30 years, Marty. So if
that was 10 years. That was actually 10 years.
Wow. Well, if you've got your calculator, mate.
Let's look at that at 30.
Well, let's say someone in their early 30s who's not going to touch their super to their early 60s. What does that return? And then the other thing that you've got, depending on tax rates, is if they do it as a salary sacrifice, they'll also save tax.
Mm-hmm. So that was example there for you. And look, I'm going to the top end, higher end of the scale here.
Do you want to know what it is? Do you want to know what it is over 30 years?
Tell us.
I love numbers, So 30 years, it is that $36 a week is $212,428.
At what return?
At 8%.
Bang.
I mean that's incredible when you look at it like that. And like Nick said, if you're getting slugged 30 cents in the dollar on tax, and all of a sudden you're getting 15% of that back because you're putting it into super, you've not only compounded that benefit, but you could tip in that little tax benefit back in.
Just one thing,
what is it?
Just in case someone really challenges us on this, but you will get a 15% tax on the contribution
in super.
Okay.
In super.
Yeah.
Okay.
So, but I would suggest, Jase, you're probably the better person to answer this, but most people are paying more than 15% in tax.
Oh, yeah. Average rate of tax, definitely closer to 30 cents to the dollar across the board. And look, and that's what these stage 3 tax cuts are a bit about, is trying to bring down everybody's average rate of tax. And that's now why we're seeing, up to, even somebody earning $250,000 a year will have an extra $3,295 in their pocket. So that's what these stage 3 tax cuts are doing, is going less income tax for the individuals means people keep more of their hard-earned money. The example I was going to use for the person who's on that higher end, $190,000, they're getting $2,661 more in their pocket per year. If they elected to put that into super at the end of the year and claim a tax deduction for that, they'd get another $1,000 back from the ATO, or like almost $1,000 back from the ATO on their refund when they do their tax return. So there's some serious benefits to go, rather than letting these stage 3 tax cuts just get kind of grouped into all your normal income and it just becomes money in the bank account and it sits there doing nothing, or you're not conscious about the decision making around how to use this money. So far, we've covered that if you have a help debt, you should divert some additional help debt repayments. If you have a credit card debt, chuck it on your credit card. If you haven't been topping up your super, or if you've got an ambition to grow your retirement wealth and add some money to super, there's an option there. And then also, if you just prefer to get a bigger refund from the ATO at the end of the year, that's also where this extra money can go into super to help you boost your refund at tax time. So I think we've covered all those so far. That aside, I mean, outside of that, all the other debt reduction strategies, if you've got loans or anything else that's higher interest that you need to pay down. But one of the other fun ones, I mean, we talked about this $36 a week being invested and having returns, would be to look at starting an ETF or a managed fund. Obviously, $36 a week isn't probably potentially the ideal amount. You might have a starting contribution where you might have saved $5,000 and you might start your managed fund with $5,000 and then set up an automatic weekly transfer for whatever that your tax cut is. So it's $50 a week. All of a sudden, you've started the managed fund that you've always dreamt about having. You're going to have a share portfolio. Again, if you don't work with an advisor, I'd stress that you can seek some financial advice and talk to someone. But there are platforms out there that allow you to start this off. Obviously, with guys like Nick and Marty in the room, this is why I stress to speak to an advisor first, because you might just end up in a better portfolio than if you try and pick one yourself. And also, it gets rid of decision paralysis, where people sit back and go, shit, okay, I listen to the numbers game. I am going to have an extra $50 a week in my pocket. And I've always dreamt of the managed fund for my child's education, 15, 20 years from now. And Marty said that if I squirrel it away for X amount of years, it's going to be worth $30,000, $40,000. Well, what do I do? So if you can't make the decision yourself, this is where you lean on professionals like the team at Innovate, who obviously help a lot of Future Advisories clients and a lot of other Australians out there. But starting that managed fund is something you won't look back. You won't look back and go, shit, I made the wrong choice, because you're going to have a guaranteed savings platform that has the right compound earnings, dividend reinvestment, and dividends paying into it to grow your wealth.
Yeah. Nick has said it many a times, like, you got to know your goals. And there's a term where people say, pay yourself first. But I like to add a word, pay your future self first. And so often people don't think about how are they setting themselves up in 10, 15 years and what's the strategy behind it. But I love that pay your future self first, and you're making a conscious effort to support your family in 10 years' time, 15 years' time, and have your money work for you. So ultimately you don't have to work for money. And I think that's using professional advice to get to these points are paramount, because you can see how small habits can significantly change the needle if you've got the awareness of what to do with those small habits. Critical to get advice around it.
I do like what you said about decision paralysis, because the amount of people, I always refer back to the Barefoot Investor book, fantastic book, and has got some great baseline learnings on how to put money away for your future and how to just be better financially. But the amount of people that come into our office who have read that book but haven't taken action, either because it's too complicated, or I know I have to do it but I don't know how, or I just didn't get around to it. So I think the key difference with having a financial planner is, number one, the decisions are made for you, and number two, the implementation is done. And then number three, we can show you long-term benefits and what challenge or what the initiatives you're doing will actually mean for yourself 20, 30 years in the future. And that's probably where we get the most buy-in. When people see that and then they start to check in on an annual basis or biannual, depending on the client, and they see the gains that are being made and they see the dent they're putting in their debt, or the money that they're creating for their future retirement, that's when you get buy-in, and then people start to ramp it up. So decision paralysis is definitely a thing, and that's why most people start too late. They start in their late 40s or early 50s when they start to think about this stuff instead of doing it.
And I think the other thing, Jase, too, that I pick up on is that a lot of people think they have to make a lot of money to make money. And again, it sort of squashes that. It's just great behaviours consistently done over time can really put you in a fantastic position. Like I said, when I think about that, I think about my son. $20 a week. Do your chores. Invest wisely. It's like it doesn't have to be a lot. And like I said, a lot of people out there will get these tax benefits and just blow it away. And just that'll be the end of it, and there'll be the same circumstances. Or they can make a decision to say, no, not this time. I'm going to set this up for the future and do it now, because really they haven't had any extra money to this point. So it's like they'll be in a new habit. Great time to do it if they can afford to do it, of course. Some people really need that money anyway.
100%. And look, I don't want to be the complete fun police. A lot of that stuff there has been talking about paying down debts and putting money in super, starting an ETF or a managed fund. The other side of it is, even if you go to something really simple, like create a new savings account, high interest saver, start to move that money across there and build yourself up a bit of a buffer that you might not have been able to attain last year or two with everything that's going on. But if you're going to have some more money in your pocket when your payday comes through, because look, this time of year as well, a lot of employers do their annual salary increase. So that not only are you going to have your annual salary increase, but also your tax cuts. Have a look at that. It might be reintroducing some small luxuries to treat yourself as part of putting that money into a high interest saver. You might then set some long-term goals, like planning that future holiday that hasn't been attainable over the last couple of years because there has been stresses with the mortgage or with credit card debt. So beyond all of the, help debts and everything else, maybe it is putting aside money for that future holiday or some small luxuries back in your life, like, a monthly dinner with your partner where you can celebrate the small wins. So, yeah. With that in mind, guys, I hope you have enjoyed a bit of a run through of how to make the stage 3 tax cuts work for you. If you have got any friends or family that are struggling, with some credit card debt, or they're talking about their help debt being out of control, make sure you share this episode with them. We'd love to share the knowledge and the wisdom. And also, if you do want to have that financial advisor chat, this is your opportunity to touch base with Innovate. Get on their website and fill out one of the contact forms, inovayt.com.au. I know that all of our clients at Future Advisory that work with Nick, Marty, Luke, and the team there, they're making these financial decisions feeling empowered because they've got multiple decision makers that they can bounce ideas off. So, you don't have to do it alone. And that definitely helps when you've got a team working around you.
Start now. Some people say it's never too late, but sometimes it is too late. So start now, draw a line in the sand, and make your money work for you. Game over.
This podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.